Hi, this is Roger Conrad. I'm editor of Utility Forecaster. You know, we emphasize again and again how important it is to know the numbers that are behind your company's earnings, how they affect the dividend, dividend safety, dividend growth, and that's really the key to what sort of returns our investments are going to produce as we hold them over the periods of months and hopefully even years. But in the near term, of course, prices move up and down, regards a lot of different factors. Now, we just came through first quarter earnings season. Things were pretty bullish, as I've outlined in Utility Forecaster. We got, and as well as in the UF Weekly, which is posted on the website. We just got our last reporter, Piedmont Natural Gas, which came in with some fairly solid numbers particularly for the 6-month period when they generate most of their earnings. That's the winter period, typical for most gas companies. So no big surprises there. In fact, all of our companies posted numbers that supported the dividend, supported dividend growth, supported management guidance for future profits, which is behind that. Since that time, though, we've seen a lot of our companies go separate ways. For the electric utilities and the more conservative fare, prices have continued to go higher. But for some of the companies that are more involved in the commodity businesses or a little more economically sensitive or even have been undergoing some challenges, we've seen investors kind of shy away from those and maybe sell them off, despite the fact that first quarter earnings and guidance were very supportive of their dividends. Now, what's going on here? Well, I think it's a macro situation here, and people are become a little bit more adverse to risk, I would say, over the past several weeks. So we've seen, again, companies like Frontier Communications sell off that have given us every indication they're going to maintain their dividends. So now those yields are back up to around 9.5%. On the other hand, we've seen some of our utilities like Dominion Resources rally to new highs. As we know, you do best when you buy companies at good prices, and that's definitely, I think, where investors need to keep their heads now. Now, right now, it's very easy to look at some of these companies that have lagged and say, well, maybe things aren't going so well. Companies like Energy Transfer Partners, for example, which has really come off its highs. It may be tempting just to go ahead and throw in the towel and say, well, these other things are doing well. Actually, I think right now is probably a good opportunity to buy some of these companies if you've been looking at them for a long time. And the master limited partnership space, I think, has been wrongly lumped in with companies that are more economically sensitive. And in fact, so we've had some selling of those. Good time to start looking at those. I have some ideas in the newsletter, the June newsletter, also in UF Weekly, for things to buy. I think that's where you want to keep your focus. As for dividend safety, as for risk, what we really want to do is stay focused on second quarter. We have to wait a little while for those earnings to come out, about a month and a half. But in the meantime, companies, again, through the first quarter have given us every indication that we can expect good numbers, that we can expect dividend safety, that we can expect dividend growth, and therefore that these are still worthwhile holdings. So that's all I have to say today. Thanks for tuning in, and I look forward to speaking with you next time.